Pack it all with one of Bay Street's notable voices. David Rosenberg heads up Rosenberg Research, and he often joins us here to break down the economic realities. Rosie, good morning to you, sir.
Hi, John. Thanks for having me on.
So I guess let's just start with your takeaway on the Bank of Canada. Nobody expected that there would be a move on interest rates yesterday. We got a touch of color, and I referenced that we'll hear a little bit more from a senior deputy later today. How would you characterize what you're seeing when it comes to the Canadian economy right now?
Well, look, I think that the Canadian economy, notwithstanding how strong the job market has been, the employment is a classic coincident, even lagging indicator. So it's not giving you a window on how things are going to look in the coming year. The leading indicators, not just in Canada, but in the U.S. and globally, are pointing to an outright recession. Canada, being a small open economy, is going to feel the brunt of that. And as far as the Bank of Canada is concerned, I think a wait-and-see approach after a tightening cycle that would have made John Crow blush is the appropriate move. Pause and assess, because we know that monetary policy hits the economy with long lags. In Canada, probably shorter than in the U.S., given the nature of the mortgage market here. But we haven't seen the full brunt of what these central banks have done. So I think the Bank of Canada, I think that what Tiff Macklem is doing makes a lot more sense than the hyperventilating that's going on at the Fed right now.
Why do you think that is the Fed's approach? I mean, you did highlight that one difference, arguably, for the Canadian economy, just what's happening in our housing market, the household debt, the mortgage realities. But why do you think the Fed is taking its approach by comparison?
Well, because, this version of the FOMC is not what it's been in years past. I've had a very difficult time trying to figure this version of the Fed out, because they're so relentlessly focused on lagging indicators. They are so focused on service sector inflation. And what's interesting is that when you go to the Conference Board's indicators, what's inside the index of lagging indicators is service sector inflation. They're focused relentlessly on the tight labor market. Well, the labor market is as tight today as it was back in December 2019, when the funds rate was 2.5% or lower, and they were cutting rates. So this Fed is focused squarely, for better or for worse, on lagging or coincident indicators. I think their principal concern is that inflation is not going to come down to their target as quickly as they would like. To which I say, so what? Whoever determined that 2% was some particular holy grail. We wrote a report several months ago showing that historically, when you're looking at the best periods of financial and economic stability, inflation is in a 3 to 4% range. And if you go back before 1992, 3% was the Bank of Canada's target. All of a sudden, these central banks are seeking 2%. It took Paul Volcker 6 years before inflation got to 2%. And in fact, core inflation in his entire 7-year tenure, the lowest it ever got was 2.9%. And he's viewed as the greatest inflation dragon slayer of all time. So I think that, I think the Fed is chasing lagging indicators, and I think that they have become a bunch of religious zealots in terms of thinking that 2% inflation and getting there quickly is somehow going to be desirable for the economy. I'll take the other side of that bet. And I say in the next year, when we get the recession unfolding and we see the impairment of cash flows causing a lot of strain in the financial markets, they'll be forced to reverse course.
Can you walk us a little bit through your thinking, at least in terms of the way the potential recession plays out? So we're sitting here in March. You highlighted the U.S. Central Bank looking at some lagging indicators. You got some people out there, just to your point about inflation targets, throwing out the idea of whether or not we should adjust the target, maybe start talking about 3%, but there's certainly no indications of anybody thinking about that right now. But at what point do we know if at any point over the course of this year, whether we've, seen that notable contraction for the economy? Like, how does the rest of 2023 into 2024 play out, in your opinion?
Well, look, there's no broader measure for spending in the economy than real GDP. And we just saw in Canada that, it came in almost flat. what's interesting to me, so how do we know? Recessions creep up on you. It's like an odorless gas. It's why the NBER usually waits 6 or 7 months to tell us that recession's already started. So it's very complex. But the Conference Board's leading economic indicator, which has a hodgepodge of economic and financial variables, has been negative sequentially now for 10 months in a row. And it's down at over 7% annual rate. So the classic leading indicator is telling you that the recession, and actually the LEI peaked in December 2021. So if you trace through the historical pattern, it's telling you that the recession begins second or third quarter. I was struck by Brian Moynihan at Bank of America saying that here we have a bank CEO saying he thinks it's going to be the third or fourth quarter of this year. I think it's going to be the second or third quarter, but it's just a matter of timing. But it is staring us in the face. How could anybody think we're going to have a no landing, which is a joke, or a soft landing in a credit-driven economy with the sharpest increase in interest rates since the early 1980s? Unless you don't believe that interest rates matter. Well, interest rates in a credit-driven economy matter. The reason why the Bank of Canada is early in going to the sidelines is because they recognize that Canada is more interest sensitive in terms of the housing share of GDP. It's double here what it is in the States. We look more like what the States did in terms of housing exposure in 07 heading into 08. And of course, we don't have the benefit of 30-year fixed rate mortgages here, so they're rolling over more quickly and having a much bigger impairment on debt service, and home prices are going down more quickly. So look, when you're taking a look at the data, you could see the decay happening in two very important sectors, manufacturing and housing. They are already in recession. You'll say, well, but the rest of the economy isn't. But you see, because the rest of the economy is more service sector oriented, but ultimately the service sector services the goods producing economy. And whether you look in Canada or the United States, it's telling you a story that the downturn is staring us in the face. But because everybody lives in the here and now, and nobody seems to look past the tip of their nose, but when you look at the forest past the trees, it's just the business cycle of play. And I don't know why anybody would argue against it. Recessions aren't pleasant, but thankfully we're in a recession 15% of the time, and we're in an expansion 85% of the time. But this is the part of the business cycle where we see the movie rewind itself. And every recession happened after an aggressive tightening, either by the Bank of Canada or the Fed, that inverts the yield curve. And so we're just talking right now about timing. Is the second quarter, third quarter? Maybe Brian Moynihan is hopeful that it's the fourth quarter. Doesn't really matter. Just know that it's out there, and it's not a 2024 or 2025 story. It's going to happen this year. And I think that when people start to realize it, it's when all the lagging indicators like employment start to follow suit. And by that time, if you're an investor, it's simply too late.
That's the part I wanted to finish on is for investors, because the other complicating factor here is you've got all this historical evidence about the challenges equities may face if you're still in a rate hiking cycle, and just based on the indications we're getting from the U.S. Fed right now, if you see typically the end of a bear market, some year plus after the final rate hike, that would take us well into 2024. I think the complicating factor for a lot of people is that this bear market actually began, at least in the United States, before we even saw the first rate hike. So how are you thinking about the markets right now?
Well, yeah, it's a very complicated situation. The stock market peaked December 2021, but remember that the multiples were crazy. What happened last year with the stock market was really more about multiple compression because of rising real interest rates. What happens this year is you start to see the earnings recession take hold. This is the year where the policy lags kick in to earnings. And so when I look at the historical record, the stock market bottoms 70% of the way through two things. 70% of the way through the recession, which people don't think has even started yet, and it probably hasn't, but it's about to. But the stock market bottoms 70% of the way into the recession when it can see the recovery happening. And that's probably not until 2024, maybe not till the second half of 2024, so do the math on that. And 70% of the way through the Fed easing cycle. And here we got the Fed. The Fed is tightening into the most inverted yield curve since the summer of 1981 in an environment where and maybe we can debate, John, whether the GDP is in an outright recession, but equity investors don't buy GDP. A good chunk of GDP is government. There is no GOV symbol in the S&P 500. You're buying earnings. And looking at the stream of what's already happened, because the earnings recession actually started in the second quarter of last year, and looking at the analyst estimates, which are coming down in dribs and drabs, we're going to have earnings going down in the third quarter of next year. You're paying for earnings. The Fed is tightening. Look, they eased dramatically into a huge bull market and kept easing into a huge bull market, and now we're in the mirror image of that, where they're tightening into an earnings recession, and they're not done yet. So this is very complicated. I think that I would say for anybody watching this show, you're getting paid to be in cash. I'd be in U.S. Treasury bills or 2-year notes where you pick up 5%, guaranteed, no capital risk, no duration risk. However, I would say that if I'm right on the recession call, then long-term government bond yields from a total return prospect is going to be a very good place to be. So I'd actually have a barbell right now. I'd say leave the equity market aside. We have not seen the lows, and I'd have a barbell between Treasury bills and long government bonds. Sure. And I think that'll be the best risk-reward profile for the next 6 to 12 months.
All right.